Hey everyone, ready for a deep dive into some serious market drama? We're going to unpack the recent stock market plunge and the Fed's role in it all.
Yeah, buckle up.
Our source is a financial news article breaking down the market's reaction to the Federal Reserve's December meeting, those interest rate decisions. You know,
Big stuff.
we're on a mission here to help you quickly grasp what happened, why it should matter to you, and what to watch out for moving forward.
It's like the market tried reading between the lines of the Fed's announcement and just totally freaked out about what it thought it saw.
Oh yeah, for sure.
Big time.
It's crazy, right?
Mm.
The Dow Jones Industrial Average just plummeted over 1,100 points.
It's nuts. And you know what? It's the Dow's longest losing streak in like 50 years.
Wow.
Yeah.
And it wasn't just the Dow feeling the pain, right?
Nope. S&P 500 and NASDAQ also took major hits.
Ouch.
It really wasn't pretty.
So this all happened even though the Fed cut the benchmark interest rate, what was it, like 25 basis points?
Yeah, 25 basis points, which, by the way, is 0.25% for those not super familiar with the term. But anyway, that brought the total rate reduction for 2024 to a full percentage point.
So they cut rates, which, I mean, usually that makes the market happy, right?
You'd think so, yeah.
Why the meltdown then? What's going on?
Well, the market was really focused on the Fed's projections for future rate cuts, and let's just say they weren't thrilled with what they saw.
Oh, okay.
Back in September, they were projecting 4 cuts for 2025, right? Now they've slashed that down to just 2.
Oh, wow. That's a big difference.
Huge.
So it seems like the market was expecting, I don't know, more aggressive cuts, and the Fed basically said, hold your horses.
Exactly. And that's where this fear of higher for longer interest rates comes in.
Okay, I've been hearing that term a lot.
Yeah, it's everywhere these days.
So help me understand, what does that really mean, higher for longer? Why is everyone so worried about it?
Well, essentially it means interest rates staying elevated for a longer period of time.
Okay,
And that has ripple effects throughout the economy.
I can imagine.
Think about borrowing costs for businesses,
Yeah.
and individuals, like mortgages, car loans, business investments. It all gets more expensive.
So it's not just about the stock market, it's about everything.
Right, it's much bigger.
So is that what sent bond yields soaring after the Fed's announcements? Especially the 10-year Treasury yield, that was a big jump.
You got it.
So remind me again, how are bond yields and interest rates connected?
They kind of have this interesting dance, As expectations for future interest rates rise, bond yields tend to follow suit.
Oh, I see.
It's all about investors adjusting to this new reality and reevaluating their strategies.
Got it, got it.
Complicated stuff.
Well, it seems like the market is really on edge right now, just trying to make sense of it all.
Absolutely on it.
And then you have Fed Chair Jerome Powell's comments, which didn't exactly help calm things down.
Not at all. He did not sound very reassuring.
Yeah, his tone was pretty hawkish, right? Like he's not inclined to make those quick rate cuts,
Nope.
like less inclined than the market was hoping for.
Right, exactly. And I mean, he even said, and I quote, "We can therefore be more cautious as we consider further adjustments to our policy rate."
Not exactly what people wanted to hear.
Yeah.
And of course, he also mentioned that the Fed is waiting to see further progress on lowering inflation, and ensuring a strong labor market before they even think about more rate cuts.
Gotta see those results first.
So it's really a waiting game now.
And markets, as you know, they really hate uncertainty.
They do, don't they? Now, this is where it gets really interesting, because you have some experts out there questioning if this rate cut was even necessary at all.
You're kidding?
I know, right?
It's a wild situation.
On one hand, the market is freaking out that future cuts might be less than anticipated.
Yeah.
On the other hand, you've got experts saying, well, this current cut might not have been the right move in the first place.
Crazy, right?
What's happening here? It's like everyone's confused.
It really highlights how complex the Fed's role is and, the debate that always surrounds their every action.
Yeah, for sure.
I mean, Byron Anderson, head of fixed income at Laffer Tengler Investments, he didn't hold back, called the Fed a helicopter parent.
Oh, wow. Strong words.
He's basically saying they keep stepping in even when the economy seems to be doing okay on its own.
I see. Interesting.
Right.
So first we've got the market worried about the Fed not lowering rates quickly enough.
Yeah.
And now we've got experts saying maybe they shouldn't have cut rates at all.
Pick a lane, Fed.
What's going on?
Well, Anderson makes a good point about the Fed's dual mandate. They have to worry about price stability, but also maximum employment.
Right, right.
So he's asking which mandate this rate cut was really serving, especially since inflation is still a concern, and he's not alone.
Oh.
Yeah, Jack McIntyre, portfolio manager at Brandywine Global, he asked a really pointed question. He said, If the market wasn't expecting a rate cut today, would the Fed have actually delivered one? I suspect not.
Ooh, that's a good question.
It is, isn't it? He's basically suggesting that the Fed might be too influenced by the market's expectations,
I see what you mean.
even when those expectations might not line up with the actual economic fundamentals.
Wow, that's a really thought-provoking point.
It is, right? How much does market psychology and sentiment actually influence the Fed's decisions?
It's a big question to think about.
It is definitely something to consider.
You know, this is where it gets really fascinating for me because it's not just about numbers. It's about psychology. It's about expectations.
Absolutely.
It's about that whole complex relationship between the Fed and the market.
Yeah, you can't separate those two, and understanding that interplay is key to making sense of how the market reacts.
It's like a dance, but a very complicated one.
Exactly. Lots of steps involved.
Well, we're going to pause here for now, but coming up in part 2, we're going to dig into expert opinions on this whole higher for longer environment and what it could mean for the economy.
Can't wait.
And then in part 3, we'll get down to brass tacks,
Yeah, the nitty-gritty.
What can you actually do with all this information? So stay tuned.
You know, it's fascinating how this situation really shines a light on that balancing act the Fed has to pull off.
Yeah, it's a tough job for sure.
They're trying to get inflation under control, right?
Right.
But they also can't cause too much damage to economic growth while they're at it.
It's like walking a tightrope.
It really is. I mean, if you raise rates too quickly or keep them high for too long, you risk triggering a recession.
And nobody wants that.
No, absolutely not. Businesses start hesitating to invest, hiring could slow down, people might start spending less. It's not a good picture.
But on the flip side, if they don't do enough to get inflation under control,
Well,
prices could go through the roof.
yeah, that's not a good scenario either.
No, it's about finding that sweet spot,
Yeah.
keeping inflation in check, but without completely stalling the economy.
It's like Goldilocks and the Three Bears.
Exactly. Not too hot, not too cold, just right.
Just right.
And that's why everyone's hanging on the Fed's every single word right now,
Absolutely.
trying to predict that next move.
Ah.
So what are the experts saying about the potential consequences then of this, higher for longer scenario? Like, what could this actually look like out in the real world?
Well, some analysts are saying that longer periods of higher interest rates could really put a strain on corporate earnings.
That makes sense. Higher borrowing costs, less money to invest.
Yeah, exactly. Companies have less money to invest and grow, and their profits take a hit.
Which means investors get less confident.
Right, and that could lead to a drop in stock prices. It's like this chain reaction.
Dominoes.
That's it.
Higher rates ripple through the whole system.
And we can't forget about everyday consumers, right? Higher interest rates mean higher costs for mortgages, car loans, credit cards.
Less money in people's pockets.
Exactly. Less disposable income means less spending, which can slow down the whole economy.
So it all comes back around.
It does.
So I have to ask, is there any good news here? Because this all sounds a little bit, well, kind of bleak.
Well, it's not all doom and gloom, I promise. Some economists are actually saying that this higher for longer situation, it could have some long-term benefits.
Really? I'm curious, how could that be?
They think by keeping those rates a bit higher for a while, the Fed could actually prevent us from seeing the kind of crazy runaway inflation that can really hurt the economy in a big way.
So it's like a trade-off, like a little bit of pain now
Yeah.
to prevent a bigger problem later on down the line.
You got it. It's all about finding that balance, controlling inflation, but also supporting economic growth. That tightrope walk again.
Yeah, that tricky tightrope.
And we've already seen, right, even a tiny misstep can spook the market.
Send everyone into a frenzy.
Absolutely.
So it seems like staying informed is super important.
Couldn't agree more. Understanding what's happening in the economy, what the Fed is doing, it can help you make better decisions with your finances.
For sure.
Be informed, be smart.
All right, so as we get ready to head into part 3, what are some things that our listeners should be keeping a really close eye on as we, navigate this new higher for longer world? What are the big indicators?
Okay, well, first, you got to keep watching that inflation data,
Yeah, absolutely.
Is it still climbing? Is the Fed making any progress on bringing it down?
So those inflation numbers, those are going to give us clues
Big clues.
about where the Fed might be headed next.
Exactly.
What else? What else should we be watching?
Pay close attention to those corporate earnings reports. Are companies starting to feel the pinch from these higher rates?
Yeah, are those profits being affected?
Because that can tell us a lot about the overall health of the economy,
Yeah, for sure.
And of course, always listen to those Fed statements and those speeches.
Oh, yeah.
Are they hinting at any changes to their policy?
Yeah, are they thinking about keeping rates higher, or they maybe going to shift gears?
It's all in the tea leaves.
I know, sometimes I feel like decoding Fed speak is like learning a whole new language.
It can be, for sure.
But it's so important to try and understand what they're thinking, right?
Absolutely, if you want to try and anticipate where those interest rates are headed.
Yeah, because remember, the market reacts to expectations.
Oh, big time.
Just as much as it reacts to what's actually happening.
Sometimes even more.
It's a high-stakes game.
It really is. It's like a chess match. Everyone's trying to predict the Fed's next move.
And the stakes are high.
They are, the decisions the Fed makes, how the market reacts. It has consequences for everyone.
For all of us.
Businesses, investors, everyday people, we all feel it.
So that leads to a really important question for our listeners, right?
Yeah.
How can they actually use this information to make smart decisions about their own personal finances?
That's what we're going to get to in part 3.
Absolutely, we're going to tackle that head on.
We'll share some practical strategies for navigating this new economic landscape, so stay tuned.
Okay, so we've talked about a lot the market's reaction to the Fed's December meeting, higher for longer interest rates, the potential impact on the economy.
A lot to unpack.
But now let's get practical.
Let's do it.
What can our listeners actually do with all this information?
That's the million-dollar question, right? Knowledge is only powerful if you can use it.
Exactly. So let's empower our listeners with some actionable strategies for this, this new reality.
Absolutely. So first and foremost, don't panic.
Yeah, good advice.
Those knee-jerk reactions, never a good basis for financial decisions.
Breathe.
Take a deep breath. Assess your own situation.
Make a plan.
Exactly. It's easy to get swept up in the market's emotions.
Oh, for sure.
But staying calm, staying rational, it's key.
For sure. So for those who are invested in the market, this might be a good time to kind of revisit that portfolio.
Infinitely.
Make sure it aligns with your risk tolerance, your long-term goals.
Right, exactly. You always want to make sure your investments are still working for you.
Yeah, absolutely. Diversification, that's always a good strategy.
Always a good idea. Don't put all your eggs in one basket.
Exactly. So well-diversified portfolio.
Stocks, bonds.
Maybe some alternative investments in there.
Helps cushion the blow when the market gets volatile.
Yeah, because it will. It's going to happen.
Oh, yeah. Ups and downs are inevitable.
Exactly. And it's important to remember, investing is a long game.
It is. Patience is key.
Riding out those market swings, that's usually a better strategy than trying to time everything perfectly.
Couldn't agree more. Time in the market often beats timing the market.
What about those of us who aren't, seasoned investors? Like, what are some practical things we can all do to protect ourselves in this higher for longer world?
Well, if you have any debt with variable interest rates, like credit cards, adjustable rate mortgages, now might be a good time to think about refinancing, lock in a fixed rate while those rates are still relatively low.
That makes a lot of sense. That way you're not at the mercy of future rate hikes.
Exactly. Predictable payments.
Predictability. We like that.
And with interest rates going up on savings accounts and CDs, this could be a great time to boost that emergency fund.
Smart.
Or maybe even look into some short-term investments that offer a decent return.
So there are some potential upsides to this higher for longer situation.
There are, especially for savers.
Interesting.
It's not all bad news. There are always opportunities, even when things feel a bit tough. It's about adapting.
Being proactive.
Exactly.
Maybe a good time to take a closer look at that budget, those spending habits.
For sure. With slower economic growth on the horizon and potentially higher prices, it's smart to be mindful of where your money's going.
Yeah. Cut back where you can.
Focus on the essentials.
Ride out the storm.
Preparation is key. Being proactive makes all the difference.
Absolutely. Well said. As we wrap up this deep dive, any final thoughts for our listeners, something to really ponder as they navigate the financial world?
We saw how the market reacted to changes in expectations.
Yeah, big time.
It really makes you wonder how much of the market's movement is driven by, psychology, sentiment, as opposed to just, cold, hard economic facts. It's something to think about as you make your own decisions.
It's a great point. The market isn't just a machine. It's reflecting human emotions, fear, hope, uncertainty, Understanding that human element can be just as important as understanding the numbers.
I think so.
Well, thanks for joining us on this deep dive into, market mayhem.
It was a wild one.
It was. We hope you found it insightful and, most importantly, useful.
We'll see you next time.
See you next time.